Are you tired of not understanding when and where swing highs or swing lows are going to form? Then during this lecture I'm going to provide you with the exact solution which you need in order to know where these swing points are going to form. Welcome to this new lecture. Determining inception to terminus, or in other words, A to B. The key to recognizing price movements. Now, what a lot of people nowadays do wrong is that they come into the world of trading, and specifically ICT trading, and what they do is they simply look for breakers or for value gaps, you name it. Whatever PD array they lose their mind over. What happens is that they purely look for that PD array to appear, and when the PD array appears, they take a trade. And you're probably listening to me speak right now, and you're like, damn, you nailed me right there. Yep, I've done it to myself as well, and it doesn't work. And the reason why is because PD arrays by themselves are only a small piece of the puzzle. During this lecture, I'm going to be sharing with you exactly how time plays a crucial role when it comes to understanding when and where swing points are going to form. And before we dive into the lecture, I just want to share with you that the background behind me is a bit different than usual because I'm right now on holiday, but I still wanted to pick up the camera and actually release this lecture for you. So let's dive into it. There are two methods for determining where swing points are going to form. We either pay attention to time cycles or we pay attention to PD arrays. These two methods are by far the most easy methods to understand. And during this lecture, I'm going to be sharing with you everything you need to know about both time cycles as PD arrays to know where the swing points will form within the markets. And please note that what I will share with you is universal, meaning this logic works across all markets, across all time frames, because it's all fractal. Meaning it doesn't matter if you're an index futures trader, it doesn't matter if you're a forex trader or a crypto trader, or if you trade stocks, it's all the same. All that matters is the time and the price. So when it comes to time cycles, we pay attention to a previous cycle high and a previous cycle low. If you are not familiar yet with the concept of time cycles, which are introduced on my public YouTube channel, I highly suggest you to check out some of my recent lectures in which I explained the topic in depth. This topic of time cycles is by far the most important to understand when it comes to knowing where and when liquidity is going to be engineered. So when it comes to utilizing the logic of time cycles, we pay attention to the previous cycle high and the previous cycle low. And it doesn't matter how big the time cycle is that you're using. You could be paying attention to weekly cycles if you're looking at, for example, swing trades. Or you could be paying attention to, for example, previous 90-minute cycles if you're looking to day trade. All that matters is that you pay attention to a fixed window of time with a fixed start and finish, and pay attention to the high and low that will form during that window of time, because during the next time cycle of the same duration, if that will refer back to that previous cycle, it's high and low. So within bullish markets, what we're looking for is we're always looking for a previous cycle low to be purged, followed by a revert towards a previous cycle high. In bearish markets, we're always looking for a purge of a previous cycle high, followed by a revert towards a previous cycle low. If you are able to recognize that price is manipulated higher when you are, for example, bearish, and we take out that previous cycle high, what should form there? A swing high, of course. What is the market going to draw towards? It's going to draw towards the opposing side of liquidity, which is sell side liquidity, which is resting below that previous cycle low. If we're looking at a bullish example, what we can look for is that the moment that we see the market open up for the next time cycle and we take out the previous cycle low, that right there is considered to be manipulation. Once that manipulation is taking place and we see the signs of a swing low formation taking place, what can we logically anticipate? We can anticipate that the market is likely going to revert towards the opposing side of liquidity, which is the previous cycle high. So are you beginning to see how we have these very fixed objective variables which we're paying attention to all the time to gauge the order flow? Time cycles are by far the most important to pay attention to. So to not use them is literally holding you back within your own analysis. And again, if you do not understand the topic of time cycles yet, I highly suggest you to go on my YouTube channel and research the lectures which I've released on it. When it comes to PD arrays then, I want you to start paying attention to the following PD arrays to gauge the order flow and to anticipate when and where these swing points are going to form. First of all, I want you to pay attention to higher time frame imbalances. Secondly, I want you to pay attention to higher time frame breakers or mitigation blocks. These three arrays are, in my opinion, all you need to be able to anticipate where swing lows and swing highs are going to form. And during this lecture, I will be sharing with you some examples as well when it comes to utilizing the higher time frame analysis to actually frame lower time frame execution. Now, what's important to note is that the reason why you're right now struggling with lower time frame trading is because you have been looking for these PD arrays simply on the lower time frame. So when every single time that they appeared, you simply went out there and you tried to take a trade. However, what if I told you that the most important part about your analysis is actually determining inception to terminus? Because once you recognize the inception of a new price swing, once you anticipate that swing low or swing high formation and everything is occurring in the right order of events, are you surprised when the market then in fact changes from sell to buy program or from buy to sell program? No. So do you understand that your focus has been on completely the wrong things all this time? You need to zoom out, pay attention to, okay, where's the swing high or where's the swing low forming? And only then can you be utilizing PD arrays to get in sync with the market move as it is anticipated. Now, when we pay attention to the blending of time cycles and PD arrays, I want you to focus on finding the array and wait for liquidity to be engineered. This takes time. Think about what I've just said. It takes time for you to find the array and to see the liquidity be engineered. That's not me just saying, oh, you need to have experience to be able to do this. That's a given. However, it literally takes time for liquidity to be engineered. A specific time cycle has to engineer liquidity in advance of the key array from the higher time frames, so that the next time cycle can open up, manipulate, so that distribution can unfold afterwards. So do you understand that paying attention to time is actually that what has been basically missing within your own analysis all this time? When we pay attention to a chart example then, here we can see the RE chart of Nasdaq. And what I would like you to see on this RE chart of Nasdaq is that when we open up for the day of Thursday, we saw the market expand towards the upside. During this expansion higher, we saw this large imbalance get created. A retracement occurred and we saw the market reach this imbalance. Once the market reached this imbalance, we saw the market expand higher and take out buys at liquidity resting above this high. Notice, however, that we saw the market then drop lower once more, trading into that imbalance, taking out sell-side liquidity resting below these relative weak lows before the real expansion towards the upside occurred. So do you see how the market had to take out sell-side liquidity engineered below these relative weak lows before it was allowed to truly expand towards new weekly highs, because this was the current weekly high? When we pay attention to the delivery then on a lower time frame chart, what I would like to see is the following. What I would like you to see is that I've plotted the time cycles utilizing the time cycles indicator. This indicator is available within my public mentorship Time Band Price. What you can see is that the market consolidated throughout London. It slowly grinded towards the downside. New York opens up at 7 a.m. And do you see how we open low and then go sideways right here? That right there is a consolidation which is taking place. When the market then expands towards the upside and takes out the London high, this buy-side liquidity pool, the moment we see that rejection taking place, my eye is immediately drawn towards sell-side liquidity resting below this low. The reason why my eye is drawn there is due to the fact that these relatively equal lows are too smooth. And whenever we see clear relatively equal lows be engineered either in advance or in a higher time frame array, in this case an imbalance, then that's a perfect drawing liquidity for us, but also a point of interest since the higher time frame order flow is bullish. So what you can see is that the market runs the London high, so a previous session high throughout the New York morning session. See the market reject that high, and what does the market refer to? It referred towards sell-side liquidity resting below the previous cycle low, 7 to 8:30. We take out sell-side liquidity resting below that low when after 9:30, and we see the market then reverse and draw towards buy-side liquidity resting above the previous 30-minute cycle high. Now I understand that what I've just outlined to you might be rather complex and it might be too hard for you to grasp right now, because what I'm doing is I'm blending sessions, 90-minute cycles and 30-minute cycles. However, do you understand that what I'm looking for is I'm looking for the bigger time cycle stack liquidity to be engaged, and based on the reaction to that liquidity, I can then anticipate what's going to happen on the smaller time cycles. We always make our analysis from the bigger time cycles down to the smaller time cycles. So if I had to give you a piece of advice, don't just go to your charts and look for a 30-minute cycle or 10-minute cycle and trade based upon those. If you are trading based on micro market structure and you're taking very small trades, then it's possible. However, in my opinion, it's more interesting to capture the real move of the day than to try and capture these very small, tiny price runs. Why? Because we are not living the trade, meaning we do not wake up simply to push buttons on the markets. No, we actually are using trading as a vehicle to fund our lifestyle. And once that perspective change takes place, you will notice that you will be more at peace within your head, and you will notice that you will actually start to enjoy your life more. And as a natural result of that, your trading is also going to improve. So do you see how it's all connected? You cannot think that, oh, simply because you're learning how to trade, that you should actively be trying to push it. You could, however, think about the consequences. You're not going to be spending time with your loved ones. You're not going to be spending time with your friends. You're not going to be engaging in the hobbies that you like. And that right there is going to drain you. At the end of the day, guys, you need to understand that this business is literally the perfect vehicle to achieve true freedom within your life. To go into trading with the mindset of trying to work hard, and don't get me wrong, in order to get to this level of understanding, you absolutely need to work as off. You need to actually commit for a few years to just spend all the time that you have, all the energy, and just have no distractions around you and just focus. However, once you come to this level and you see exactly how these high frequency trading algorithms are constantly repricing these markets, then all of a sudden you will have a lot of time, because all you need to do is show up when the swing high or swing low is forming. And I'm literally showing to you during this lecture how to know when that swing high or swing low is forming, because it's in that process that you will be able to understand, okay, you can utilize alerts, and when those alerts get triggered, when those points of interest get met, where you anticipate inception of a new price swing, only then are you interested in looking at the marks. And the rest of the day, you can literally just do whatever you want, whether it be spending time with your family, whether it be, for example, training, whether it be sports, or whether it be whatever you want to do, you can do it. And that right there is one of the most beautiful realizations I had. I'm sorry for the rant, but just something I wanted to throw out here, because I understand that many of you are probably getting into trading now simply with the desire to learn how to trade so that you can replace your current income with your job. However, understand that that right there does not require as much effort to achieve than what you think it does right now. Right now, you're thinking and probably looking at this lecture as well, and you're like, damn, this is tough. Damn, this is hard. Yes, it absolutely is. This is the most complicated business in the whole world. However, once you understand it and once you begin to see it, and I cannot tell you when you'll begin to see it. However, I promise that if you put in the required work, if you keep on showing up every single week, every single day, and you keep on studying what I'm sharing with you right here for free on my public YouTube channel, I promise that you will never be able to look at these marks from the same perspective again. And if you don't believe that, just look at all of the impact which is being made simply by people following along with my public lectures. The amount of people that are taking the exact same trades as me is absolutely ridiculous, and it's so fulfilling to know that. It's one of the most beautiful things to realize that I'm making independent traders, because I'm not telling these people to go out there and buy and sell something. I'm not telling them when to go long or when to go short. No, they're making that decision based upon their own analysis, and they're using the concepts which they learned from me. And that right there is beautiful. I'm not a financial advisor, but I'm simply sharing that what has been working for me over these past few years. And that right there is something that I really hope that you will one day achieve as well. But when it comes to this type of delivery, do you notice as well that the London low was taken out at the beginning of the New York Open? So we manipulate below the London low, revert towards the London high, purge and revert. That right there is already a trade. But if you want to take another trade, what do you wait for? You wait for sales liquidity to be engaged, wait for the signs of a swing over formation, boom. Again, originating from that same REBC. Now, when we pay attention to that REBC in particular, the reason why that REBC is so important is due to the following. When you pay attention to this high right here, which we displaced through when we open up for the day, and we go to the left, do you notice that that high formed inside of this CB right here? Do you see that we have CB high BC? That right there is my market structure shift pattern. And when I see that on the RE chart or whatever higher time frame chart I'm using, because it depends on whether or not I'm framing a day trade or a swing trade. But when I see that market structure shift pattern on a higher time frame, whether it be RE chart or daily chart or weekly chart, that right there is to me the perfect sign that I'm going to be waiting for a retracement into the imbalance. And when that retracement occurs, I'm going to be actively monitoring whether or not we're going to see the signs of a swing formation take place. Now, let us take a look at another example. What you can see right here is that in front of you, you can see that I've again marked up this REBC right here. Notice that on the day of Thursday, we saw the market distort time inside of that REBC. Market was just going back and forth, back and forth, back and forth. It was going sideways. Inside of this delivery right here, time distortion is occurring. And that means that we need to wait for the next trading day before the real opportunity is likely going to be presented. There was a beautiful buying opportunity during the 9:45 to 10:15 macro inside of this low formation right here. But that low formation took place outside of this REBC. And you might be wondering, why is that still a buy then? Well, I'm looking at this delivery outside of that REBC as manipulation. So this delivery which I've outlined right here is purely manipulation, because when you pay attention to the bodies, what you can see is that the bodies kept on closing inside of that REBC. So as price is manipulating below that REBC, my eye is drawn to, okay, where is this candle going to close? Are we going to see the 10 AM RE candle close inside of this REBC? And what you can see is that it did, and that right there suggested that we would likely draw towards buy side liquidity resting above this high. However, this is a very advanced trade, and I'm not going to break it down during this lecture. What I will be breaking down with you is the following. What I will be breaking down is this delivery right here, because this is the type of delivery which I want you to focus on, because I believe that if you just focus on what I'm about to outline to you and you pay attention to this every single week, you are going to see opportunities, and they're going to be repeatable. They're going to have the same algorithmic signatures again and again and again. But hey, there's no algorithm, right? It's hilarious at some point where you see these people claim that there's no algorithm, that these markets are random, but yet you're seeing the same objective variables based upon the time and price perspective repeat day in, day out, week in, week out. And I don't want you to believe anything I say. I don't want you to just take my word for these concepts. I don't want you to just go out here and simply say, okay, because you says so, it works. No, you need to go into your own charts and you need to do your own investigation. And when you do that, you will begin to see. And once you see it, man, oh man, cherish the feeling, because I remember exactly what it felt like for me, where I was like, it's the same process again and again and again. And at some point, you will actually get to a stage where it will get boring. And once it gets boring, that's when you know you've arrived. Until you get to that stage and you notice that you're still very excited and you're very motivated, this and that. And don't get me wrong, I always am going to appreciate this level of precision, but it doesn't give me the same sense of fulfillment that it used to when I was basically completely brand new. Now, after a few years, it just feels normal. I know these markets are rigged. I know this happens all the time. I know how these HFT algos are repricing the markets. And I promise that if you put in the work, you will also get to that level one day. But what I would like to see is that when we pay attention to this delivery, we open up the day, and the first thing that happens is that the market expands towards the downside. Notice that I've outlined the London high right here, and I've outlined the London low. We're going to be paying attention purely to what happened during London and New York AM, because this is very important to understand. If we pay attention to what happened between London and New York AM, what you can see is that London initially expanded towards the downside, and we saw price begin to consolidate. We then see 9 AM open up, drop lower right here, and it's in this wick that manipulation is taking place. Why? because what you're seeing is that accumulation is occurring, manipulation, and what always follows after manipulation, distribution. How do I know manipulation is occurring? Because the higher time frame institutional order flow is bullish, I'm anticipating higher prices, and what you can see is that we manipulate below a time-based liquidity pool, the London low, we reach that same hourly BC right here, which we were paying attention to throughout the past few days, as my private mentorship students know, because this imbalance to me was the imbalance which had to function as support on price in order for us to remain bullish on Nasdaq. What you can see is that the market took out the London low and then expanded towards the upside. So a question which you're asking yourself now is, how do you know that manipulation is taking place? How do you know that this manipulation is coming to an end? The answer to that question lies right here. What I would like to see is that the SMT detector, this is the automated SMT detection tool which I've created together with my team, which basically just plots all of the SMTs on the charts automatically, and only the SMTs that are time cycle SMTs for your info. Because what's interesting is that you have all these different tools out there nowadays that showcase, oh, there's an SMT now. Oh, therefore we should do something, right? That's what the tool suggests. However, what all these tools are getting wrong is that the only SMTs that matter are time cycle SMTs. SMTs relative to either sessions or smaller time cycles such as 90, 30, 10-minute cycles, or even 3-minute cycles. Once you begin to start paying attention to these specific SMTs purely, I promise that it will be way easier for you to find out what the real SMT is. So because we are seeing SMT right here be established relative to the London session low with the S&P, with ES, that is signaling to us, hey, we are seeing manipulation on Nasdaq right now. This manipulation is coming to an end due to the SMT. So now we're going to see an expansion higher. Do you see how straightforward that process is? Is there anything complicated about that? You might be thinking to yourself, damn, this is quite a lot. Yes, if you're completely brand new, you understand that. And if you come back to this lecture a few months from now, you're going to be like, damn, I begin to see it, I begin to grasp it. But for some of you who have been with me for quite some time already, you're probably smiling because you're like, yep, it's the same process again and again and again. And that right there is the beauty of looking at these markets from an algorithmic perspective. Now, when we zoom into this delivery, what I would like to see is the following. What I would like to see is that the market opened up at 9:30 and initially expanded lower. Notice that the London low was already taken out prior, and we see the market take out sales liquidity resting below this low. Notice that the market then reprices higher and takes out buys liquidity resting above this high. The low and high which I'm referring to right here are the previous 30-minute cycle low and high. We see the market then expand towards the downside, and we see a big manipulation lag taking place. Sales liquidity resting below this low right here gets taken out, and do you see how this CB gets created? SMT gets established, we see the market displays above the CB, and that CB is a real inversion to value gap, because that right there is not the CB to short of, it's not the bearish value gap to short of, it's a bearish value gap that's going to function as support on price, because high frequency trading algorithms are going to be doing one thing, and that's they're going to be firing in their long orders from there. We see the market reprice away from that fair value gap, expansion, retracement, expansion above the high, which set up that final run lower. Market retraces once again into that, and that right there is another buying opportunity. Notice this small little inefficiency which forms, and we see the market expand towards the upside. Notice how the market retraces back into that RE fair value gap, that RE imbalance, and we see the market then open up for 10 o'clock, the new 90-minute cycle, expand higher, take out the previous 90-minute cycle high. That's a very good partial, and the next partial is the London high. So what I would like to see is that what I'm literally referring to all the time is a time cycle high and a time cycle low. When I blend that with a higher time frame array, whether it be an imbalance, whether it be a breaker or mitigation block, I'm able to anticipate where these swing points are likely going to form. With that being said, I hope that you found this lecture insightful. I hope that you're able to take away many gems from it, because I shared a lot. If I went too quick, I highly suggest you to go over the lecture once again. Please let me know in the comments if you would like to see more like this. And if you are not subscribed yet to my channel but want to be notified whenever I create a lecture like this, please press on the subscribe button. I want to wish you good luck in your studies and understand that everything which I shared during this lecture is the foundation of this algorithmic perspective. There are a lot of deeper insights which we can dive into, however, that will all come in the future. For now, this is all that you need to begin seeing these marks for what they truly are, which is rigged. Good luck with your studies. I look forward to speaking to you soon again. Be safe.